Welcome to the EACC's webinar about the quarterly EU economic update. This time it's different. Europe builds on its foundations for stability and growth. This event is organized by the European American Chamber of Commerce, New York, in collaboration with the EU delegation in Washington, D.C. My name is Yvonne Bendinger-Rothschild. I'm the Executive Director of the EACC New York, and I will be moderating today's event. My conversation partners include Ben Carlina, he's a senior economist at the delegation of the EU to the United States, and Willem Kooi, the Counselor for Economic and Financial Affairs at the delegation of the EU to the US. Today's discussion comes at a critical moment in the for the European economy. The EU Spring 2026 economic forecast was released against a challenging backdrop: the conflict in the Middle East and the resulting surge in global energy prices. Other than reining in higher energy costs, we will touch on the work that the EU has done to improve the business environment across its member states, and including a variety of initiatives, one of them defense, innovation, and the simplification agenda. With the war against Iraq, many observers immediately drew comparisons to 2022, when Russia's invasion of Ukraine triggered a severe energy crisis across Europe. But the forecast makes an important point. This time, Europe enters the crisis from a very different position. So the EU economy still faces clear challenges, among them obviously higher energy costs, slower growth, tighter financing conditions, along with a few concerns related to its competitiveness. But Europe is also much more resilient than it was just a few years ago. The report highlights structural adjustments, such as reduced dependence on fossil fuel, expanded renewables, stronger energy infrastructure, and resilient labor markets, as well as ongoing efforts to improve investment conditions across the EU. So today we will explore the outlook itself, what the developments mean for businesses, investors, and transatlantic cooperation. And with the now imminent Savings and Investment Union, one of my favorite topics, we'll discuss whether Europe is becoming not only more resilient, but also more interesting as an investment destination. So let's get right to it. Why is the shock different than it was in the past, the energy shock? Europe faced a few challenges as it relates to the geopolitical environment, and among them tariff uncertainty, but easing inflation and a robust investment cycle, due to, among others, in Europe and in the US, the same situation, unfolding AI revolution, which is evidenced by the growth in a few member states. The EU economy was strengthening while inflationary pressure was easing. So how is the energy shock? The question is for Ben. We start with you. How is the energy shock different from the last one?
Well, Yvonne, it's nice to be back with you again. But you know, we keep living in interesting times, one shock after another, it sometimes seems. But the point that you made at the beginning is absolutely right. Last time when the Russians invaded Ukraine, there was this enormous shock, and there was a number of key differences. The first one was that Europe was heavily reliant on imports of Russian oil and gas that came via pipelines. And these sources of energy were shut off, not exactly completely overnight, but very, very rapidly. And so Europe was, scrambling to come up with new supplies, and there were real fears of energy shortages as opposed to just price spikes. This time, the closure of the Strait of Hormuz has triggered this global energy shock. This is still a challenge for Europe. Europe's going to have to pay more for its energy imports. So it's a terms of trade issue. But so far the price increases have been less severe. There's no risk of any real energy shortages. And Europe is a rich continent, so it can afford to pay for energy imports. But there's other differences as well. First of all, in the wake of the war in Ukraine. Europe made some, very, very difficult, but ultimately pretty successful structural reforms to make it less reliant on energy imports. There's a vastly higher renewable energy sources in Europe, and households and firms have become much more efficient. But the macro environment was also different. So when Russia invaded Ukraine, we were still coming out of the pandemic. There was a lot of fiscal stimulus in the system. Monetary policy was really easy, and inflation was already accelerating. So it caused this huge spike in inflation. This time, it's looking very different. Um, Fiscal policy is broadly neutral. Inflation was at target. Um, the labor market was roughly in balance. Financial conditions were tighter. So, the ground, the situation where we're coming into this was very different. It's still a challenge, but Europe's much better prepared, and the shock's going to be less severe.
Interesting. Thank you for that. Willem, do you want to add anything?
I think Ben has explained a lot, and like Ben, I would like to thank you for the opportunity to participate here and having us here. It's a great pleasure to be connected to New York. Um, no, I mean, I was just thinking back of about a year ago where we were at that time of the spring forecast. Back then, actually, we would have been there at the same place at the same figures for GDP for the euro area or the EU as back then. Now, had it not been for this latest conflict, the conflict in the Middle East, actually, we would have had a bonus for 2025 because 2025 would have been 0.3 percentage point higher, the growth, GDP growth in 2025. And that only attests to the positive momentum, which Ben also alluded to, that we were in before the conflict in the Middle East. We had last week a confirmation of 0.3 percentage growth of the GDP in the first quarter in Germany. So it just attests. I mean, the whole situation now is better, so to say. Could have been better, but we are more resilient, I think, right now, and the macro environment, broad macro environment, is also better. And of course, we will touch on this, Yvonne. I'm sure there are also structural issues that have come forward since we last met in autumn. And I hope the next time we again, when we meet, we will have even more. But then we can maybe go into also Draghi and Letta, where we stand on that one by that time. Okay?
Yeah, we will have a couple of discussions on Draghi and Letta before we get to that point. One thing, and just on the backdrop that the German Chancellor was having lunch with the so-called Wirtschaftsweisen, which is an advisory team that analyzes and reports back on the US on the German economy to the Chancellor, and we're all, the German among us, are waiting to hear what they had to say. But one thing that I think is always interesting, and I think we briefly discussed that in the prep, when we're talking about the EU versus the US GDP, there are a couple of factors that play into that to make that a fair comparison. Among them, exchange rate and purchasing power. Ben or Willem, do any of you, either of you, want to just give us a quick primer on that?
Well, I mean, the exchange rates, of course, matter in terms of calculating GDP per capita, and purchasing power parity calculations as well. I think it's interesting to note that in the US, you've had surprisingly strong growth numbers coming into this crisis as well, but it's really been driven a lot by AI investment. And if you look at the broader economy, obviously it's incredible what's going on in the tech sector and the build out of data centers and all those things. But the broader economy has seen much more modest growth. Corporate investment hasn't been great outside of the tech sector. And so it's important to identify what the various strengths are of different places around the world. And likewise, if you look at Asia, um, the US is a net exporter of energy, and so it's much more insulated from these kinds of shocks than other parts of the world. But Asia imports, I think, about 70% of its total energy imports from the Persian Gulf. And for Europe, I think the number is just below 10%, 7 or 8% or something
Mm.
like that. So obviously, Europe is still exposed to price increases, but the kinds of disruptions in supply chains that you're seeing in Asia are not happening in Europe.
Yeah, it's interesting.
Maybe to add, not just a kind of interesting and fun fact perspective to comparing the EU to the with the US is when I sometimes want to have a discussion is say, well, the US is actually beyond AI, it's mostly an healthcare economy. And if you then compare levels, so to say, the number of people working in healthcare and social services in the US and the EU are about the same in the numbers. But in the EU, they cater for 100 million more people. While our population is more aging, so there are these interesting comparisons. So and kind of nuances when it comes to comparing the EU with the US, and actually when it comes to AI, and I think we'll discuss that later. Actually, there are huge opportunities also in the EU when it comes to the application of AI.
Yeah, for sure. I mean, I was just looking at the heat map of today's stock market, and it's up obviously in the technology sector, but then also the retail, funny enough, but that's only because of Amazon. And then consumer durables and consumer non-durables.
Discretionary.
Yeah, discretionary spending. So, but where it's really up more than that is healthcare. So
Yeah.
you're absolutely correct with that assessment. One more look to the EU for a second, and I don't want to dwell on that, but just a comment from both of you. Is it fair to say that Europe has learned important lessons from the last crisis, energy crisis, that is?
Oh,
Yeah.
absolutely. And they're super relevant for today because, I mean, obviously consumers don't like paying more to fill up their car with gas or heat their homes or whatever. So there's political pressure on politicians to try to limit the impact of these energy price shocks. But the main thing is that any fiscal measures that you roll out need to be targeted, timely, and temporary. I cannot emphasize this enough. You know, EU member states, many of them don't have unlimited fiscal space. You need to be, very thoughtful about how much you increase your budget deficit. But more to the point, you don't want any kind of fiscal measures to interfere with price signals. So, when you hear calls to cut or suspend fuel taxes, that's not a first best policy choice. The cure for high prices is high prices, right?
Mm,
Consumers respond to high prices by reducing demand. Either they buy a more efficient car or they put insulation in their houses. They just use less. And so, given Europe's reliance on imported energy, every euro spent suppressing energy prices just finances a higher fossil fuel import cost.
mm,
Whereas every euro that you invest in renewable energy generation or upgrading your electricity networks and storage capacity, that reduces your vulnerability to external shocks.
mm.
So, these two things, you don't want to blow out your budget deficit and you don't want to interfere with price signals. These are the main things that we have to keep in mind when anybody's trying to come up with a policy response to the shock, but particularly in Europe.
Yeah, and I also, it's interesting that you say that because that's exactly what I was writing down as a follow-up. Housing in Europe is definitely much more energy efficient. And I don't know, do we have the same dependency on cars for transportation, people getting to work in the morning, or is it more focused on public transportation? I'm not sure if I know the answer to that, but do either one of you happen to have
Europe's a
that?
big place.
Yeah, there's more rural
you
areas.
know, so you saw, if you live in rural parts of Europe, I think you have to rely on automobiles just like in the United States. But certainly
Mm,
cities have much better public transportation infrastructure, and so there are more options if you live in a big city. But you know, it's an issue. So
mm,
you have to be thoughtful.
yeah. Let's go back to the global environment. How does the closing of the Strait of Hormuz affect Japan, China, the UK, and if you want to address that for a minute, and the US?
Well, so the closure of the strait has cut global supplies of crude oil and natural gas by about 15 and 20% respectively. So there's a lot of supply coming out of the Persian Gulf. Some of it has been able to be rerouted on some pipelines through Saudi and the Emirates, but it's still a really big shock. And there's also been some damage to production facilities, like one of Qatar's natural gas trains is offline following Iranian drone and missile attacks. And there have been attacks on pipelines as well. Um, so, this is an issue. I think one of the things to think about in terms of the global economy is I was mentioned earlier that AI investment has been a huge driver of US growth outperformance over the past couple of years, but that's also been supporting growth in Asia.
Mhm.
There's lots of, semiconductor manufacturing. A lot of the
Yeah.
supplies that go into new data centers are coming from Taiwan and South Korea and places like this. And there is this risk that, Taiwan, for example, does not have huge amounts of natural gas storage, but the semiconductor fabs, consume a lot of electricity in order to make their chips. And if there were to be disruptions over there, that's a risk that we should think about, that there could be bottlenecks in supply chains coming out of Asia. Not only for tech equipment, but more generally. So that's an issue. Um, but likewise, I think that the people who are going to be worst affected by this crisis are countries in the global south that are poor, because like Europe, Japan and South Korea, they're rich enough that they can afford to pay higher prices for LNG imports, for example. Whereas if you're Bangladesh or Sub-Saharan Africa, those are the places that might actually see energy shortages in the wake of this.
Yeah, we have a slide on that actually. It might be
Go
interesting
for
to
it.
bring that up, slide 4, energy on energy imports. And it shows kind of the revisions that we made. So overall, the EU has been downgraded about the same as the world economy has been downgraded. Although for 2026, the economic growth, although the US has actually been upgraded in our forecast. So if you're talking about, so to say, the distribution of the impact, now that is GDP. Of course, the inflation story adds to that. And interestingly, actually, the changes here in the US relative in percentage are higher in terms of gasoline prices than in the EU. That has to do something with, so to say, that in the EU there are more taxes which are rising not with, as much, but it's an interesting to see that gasoline prices have risen by 50% around here, and so it's not as if the US is totally shielded from these price increases, which is kind of attests to what that in the EU, through diversification, we are now more reliant also on the global market for gas and natural gas in particular. And this whole diversification is kind of what we learned throughout the years. That's not to say that we didn't know this before, because of course we reacted also and became increasingly more apt at reacting to shocks. I mean, if we look at the pandemic, then the Russian invasion, what you saw, for instance, that the RF, which was a reaction, which was a major macro impulse to the EU economy, actually we transformed that into what we called Repower EU when Russia invaded the Ukraine. So that is there to say that there are reactions at scale in the EU, although there's more, of course, that can be done, and that is being done right now. Because, for instance, Ben did mentioned indeed the LNG and the fuel, but the other thing is, of course, the fertilizer, for instance, which will impact developing economies more. But so there's also in the EU there's an action being taken right now, the fertilizer action plan, and I'm mentioning this because I think it's an interesting example of how policy making has evolved. So with the RRF, with the next generation, which is the next generation, large part of the next generation EU, what we've seen is a trade-off between reforms and money. So you get your funding from the EU, but there's kind of a push that comes with it to make your economy more competitive, to reform, to push through structural reforms. And the fertilizer action plan has kind of so to say, is helping the farmers, but also helping them to become less dependent in the future on imports of fertilizer. So that is kind of shielding you. But this is drifting away a bit from your question on the global economy, but I linked it to fertilizers, and I thought I'd bring it up right now. Thanks.
Yeah, and fertilizer is a huge topic. I mean, I saw a report. I think it was Bloomberg also about it was France 24. On the situation in some African countries, they're hit in a double way twice. One is the rising price of fertilizer, but then also the transport of the food, which is mostly diesel driven. So that's why that graph went straight up in the developing countries. Wanted to get back for a second on the lessons learned from the 22 shocks. I mean, you already mentioned the resilient, the RF, the resiliency facility.
Yeah.
What's the word I'm looking for?
Recovery resilience facility. I mean,
exactly,
I had to train it. I had to train to remember that.
Yeah, and then also other price signals, cutting fuel taxes and other things. The latter not necessarily being good policy, no? I think Ben, you had a comment on that.
Yeah, well, the some of the price subsidies that were rolled out in the wake of Ukraine, I mean, it was expensive. I think I can't remember the exact number, but something like 2 to 2.5% of GDP was spent on fuel subsidies in the wake of the war in Ukraine. And the good news is that so far, there have been some policy responses in EU member states, but so far the cost of these, fiscal measures is 0.1% of GDP. So they're much smaller and more modest. Obviously, the key factor is going to be how long does the Strait of Hormuz remain closed, and how high do energy prices go. The longer this conflict lasts, the bigger the economic impact will be. But I think that there have been lessons learned, and policymakers are aware of these. So hopefully that will continue. But maybe to back up a little bit and just talk about where we were when we came into the war in the Persian Gulf. Last year, you had pretty good economic numbers coming out of Europe. For the EU as a whole, the economy grew by 1.5% last year. Every single member state grew. Domestic demand was stronger than expected, thanks to a very solid labor market, real wage growth. People were starting to spend some of their excess savings. Consumer confidence was improving. You had business investment stepping up. Some of it was in, intellectual property, particularly in Ireland, but even across the board, there was growth in equipment and capital goods investment in most countries.
Mm.
So these were good things. The commission was actually preparing to revise up its economic forecast compared to the previous one that they published in the fall of last year. And so, you know, there were some weak spots, but generally it was pretty good. So, but now with the conflict in the Middle East, there has been a downgrade because Europe is going to be affected by this. So this year, the Commission's looking for 1.1% growth in the EU. I think it's 0.9 for the euro area. And then you'll see a bit of a recovery in 2027. You'll see 1.4% growth in the EU, 1.2 in the euro area. So this is just a marginal downward revision from where we were in the autumn forecast. It's a downward revision of 0.3 percentage points for this year and I think zero point 0.1 for next year. But it's actually a bit larger than that because otherwise the growth forecasts were going to go higher. So that's kind of where we were, but now the big issue is going to be, and this is true for policymakers on both sides of the Atlantic and all over the world, is what's going to happen with inflation because you know that energy and fertilizer and other inputs like there's a lot of helium produced in the Persian Gulf, but also some, industrial metals have been seeing price increases like aluminum. So the question is, when will the increased cost of these key inputs start to cause broader pricing pressures, core inflation to step up? And that's sort of the key question right now, facing not just central bankers, but everybody.
Yeah. And that's a that's a challenge, nevertheless, because it will directly affect the investment outlook of companies and the overall economic sentiment as well. Along those lines, financial conditions in the EU. So for people outside of the EU, especially our friends in the US, what do you think is still misunderstood about the EU economy today? In this broader context that we've been talking about.
If I may, we just had the slide on with the EU growth map. And sometimes it's good to remember that when it comes to the EU, you get if you buy into the EU story, you get two for the price of one, in the sense that you have a highly industrialized, advanced part of it. But maybe we can bring on the slide again, and you have the emerging Europe part, and so. There are two sets of opportunities here in Europe, and actually, if you look at this slide, you will see that Poland, for instance, is doing very strong. And actually, irrespective of everything that's happening in the global economy and the challenges, be it trade, be it energy, be it geopolitical tensions, actually the growth forecast for Poland has been revised up. Spain is also doing very solidly, as is Greece, and you see that here when you go to the right is where the darker green is in 2027. So where the potential is. So I think that is kind of something we should highlight, that you get two for the price one. That's one thing. The other thing is that we should not. We're very good at being what I would call what people would call realistic, but it is maybe a bit on the pessimistic side, right? We've had this, we now have this shock, but as I alluded to earlier, we also have this policy flexibility that we now have. So we changed the Next Generation EU RRF. To become more repower EU oriented, so there is this flexibility, and I would say, but we will get to that. I think Yvonne, the market integration package for the savings and investment union, where I now hear increasingly talk. It's not an option anymore. It's our choice. It's necessity. is something we simply have to do in this new geopolitical context. So that's going to create huge opportunities. And then later I would like to connect three dots. So the savings and investment union, and then scale up the EU Scale Up Fund, which is an important one. I would like to connect those so that to see what the opportunities, to show you the opportunities. But let's go. So it's yeah. I think that is kind of what we should bring across here. Of course, it would be good to have more of this solid American optimism on the other side of the big pond. I think that would help, and I think that if investors would come to the US with a bit of that optimism, then there would be a great marriage between chances that the EU gives and the optimism that we need. And yeah.
But doesn't it tie in directly to the financing conditions? Because we have the financial markets broadly, so central banks' credibility, monetary policy, price stability, tightening of credit. We have the government bond market, and then we have the corporate access to funding. So that really levels out within those three buckets. The US is coming out really well. And because of, I don't want to say the lack of regulation, but necessary policy adjustment, among them, the Savings and Investment Union, the EU is coming out behind or hasn't caught up yet because we don't have the same strength in our financial markets that you have in the United States.
Well, I think there's a couple different issues here. One is that globally we have seen an increase in sovereign bond yields, and that's been true in the United States as well as Europe. The 30-year Treasury bond was above 5% recently, which was the first time in that's the highest yield that the 30-year Treasury has had for decades. But I think this is largely about inflation increasing because, if you're a bond investor, real yields matter. And so it makes sense that yields are going to go up when you have an environment where inflation is increasing. And, the situation in Europe is that inflation has been much better under control than in the United States. Inflation was at target heading into this conflict. It's been at or below 2% for much of the past year in Europe. And in April, I think HICP inflation printed at 3%. And the Commission's forecast is that headline inflation is going to move up to about 3.5% by the fourth quarter of this year before declining in 2027. And so this is, significant, but the CPI printed at 3.8% in the United States. So inflation is more under control in Europe, and there's going to be a jump. But if you're looking at what your real yields are, that's an important factor. And just, we are not the ECB, so we need to be careful. But I will mention a little bit because President Lagarde has kind of laid out three policy options for the central bank. And this is broadly true for how all central banks are going to be looking at this crisis. One thing that central banks can do is just look through this temporary shock, particularly if the strait reopens soon and the pass-through to inflation is relatively contained and temporary. It makes sense for central banks to look through a temporary inflation shock because it's not permanent. So that's one option. And I think if the conflict ends quickly, there's still a chance that you're not going to see the ECB hike at all. But if the shock does last for longer, the second option for the ECB is to do sort of measured tightening if the inflation shock is large but not necessarily persistent. And it's only in the worst case scenario that there is like a permanent or semi-permanent closure of the strait and you get a large sustained increase in inflation that you have to take more drastic measures. And so I think one of the issues here is that but in that scenario, in a scenario where you have a really prolonged disruption to global energy supplies, then the inflation forecast gets a little trickier because there's going to be demand destruction and slower growth. And so other sources of inflation, like, wage growth and things like that, might be less of a factor. So for all these reasons, it's not clear that the ECB is going to be much more hawkish than the Federal Reserve, for example. And so these are factors that investors have to take account of. And the second big issue besides inflation is the fiscal path of various countries. And here it's important to point out that the fiscal trajectory in the United States is really unsustainable right now.
Yeah.
You've got budget deficits that are around 7% of GDP, which is enormous and practically unheard of outside of major crises, which I don't think this one quite is of that magnitude. But Europe still has fiscal rules. The fiscal rules have been modified a bit to give countries flexibility to spend more on shoring up their defense spending and infrastructure spending to get energy independence. But deficits are smaller and they're not on this unsustainable path in Europe. So I think both on the inflation front and on the fiscal trajectory, there's good reasons to think that there's a more stable environment in Europe than in some other places in the world.
Yeah, I mean, the EU is definitely set up to absorb the shocks much better than some other countries. Let's go back to the energy resiliency and competitiveness. The report makes a point that renewables are no longer just climate policy. They've become a part of Europe's economic security strategy. How much has the energy transition really improved Europe's resilience? I mean, everybody has the example that Germany shouldn't have shut down its nuclear power plants. Was it a smart move? Was it a bad move? How are we doing on green energy? How are the green transitions, I should say?
We have these three nice graphs here, which I think tell you quite a bit. I mean, whether you want to talk about renewable energy or fossil-free, what you see is that the energy intensity has dropped dramatically, and this is part of the whole energy transition. And indeed, I mean, this is not anymore about just economics; it's also about political and geostrategical choices, because the EU is an importer of energy, and in that respect, it's very I'd say exposed to changes in energy prices, in energy supply. So the lesson from the last time was that if you have only one pipeline, well, not one, but a few pipelines that can be shut down on short notice, then you're very exposed. That was kind of the lesson that we learned. But I think generally more on the positive side, it is also showing that, if you go through the transition, then you can disconnect. You can have less volatile energy prices and electricity price. So this is what the two graphs on the right say. In particular, the one all the way to the right shows that the disconnect between electricity and fossil fuel price, which has gone up. Well, in the graph, it shows the correlation between the gas price and the natural gas price and the electricity price. But you see the huge change. And what is happening here, and for instance, Spain is exemplary here, is that actually it's disconnected because there's so much more renewable energy. So you're not all the time linked. Your price of electricity is not all the time, or is only in half the times now linked to the price, the fossil fuel prices. So that is going to be kind of maybe an improvement on a point that the EU wasn't that strong when it comes to competition. Now, of course, we will always be, or we still have a long way to catch up, and we should not forget what our ambitions was and why we now much better why we have that ambition.
Mm.
and that is what we're going to do going forward.
Yeah,
There's
I think
there's
it's worth emphasizing how much this crisis has just reinforced political support in Europe for pursuing energy independence. To your point, Yvonne, uh, it was not a great idea to shut down all the nuclear generating plants in Germany, and nuclear is definitely going to be part of the mix in Europe and an increasing part of the mix because there's going to be investment in new capacity of nuclear. It's not just solar and wind power. Nuclear is definitely going to be part of the mix. There's going to be massive upgrades to the electricity grid that include battery storage and things like that, so you can smooth out some of the peaks and valleys of electricity demand over the day, over the course of a day. All of these things are really important, and it's also worth saying that some of the reduction in the energy intensity of the European economy of demand for energy is because very energy intensive businesses have really struggled over the past few years.
Mm.
It's it's if you're the chemical sector and natural gas is one of your primary feedstocks as well as requiring energy to run your operations, it's hard to be competitive with parts of the world where energy is much cheaper. So you're also seeing structural shifts away from energy intensive manufacturing more towards the service sector and things like that. And I think that we should welcome this because this is another factor of like being able to adapt to a changing environment and come up with solutions that are going to improve the living standards of everybody. And so there I don't want to underplay that there's challenges here. Some people are going to lose their jobs, but eventually new and better jobs are going to be created. So in the long run, it's for the best.
Yeah, I mean, you're talking about the data centers and AI, et cetera. But I think I've seen that myself. I mean, I was visiting family a couple of months ago, and all over Germany they were setting up improving on the grid. There were cranes and everything all over the place, and everybody seemed to be working on the on electrification all over Germany and or at least all over the Southwest where my family is from. Um, and I think also companies have really put a dent in their usage, and you saw that on the graph all the way to the left. That the usage is down, output up, usage down. I want to move on because we only have about 15 or so minutes left to other inflationary challenges, such as weaker export performance. What does Europe need to do to improve upon that?
Well, so you're right to point out that there are some competitive challenges. One of the side effects of the increase in U.S. tariffs on American imports from the whole world is that there's been a redirection of Chinese exports to everywhere else besides the United States, basically. So some of it's going to Europe, a lot of it's going to Southeast Asia and emerging markets in general. Um, and this is an issue, but in terms of the policy space, one of the things that Europe is really focused on doing and has already been quite successful on is diversifying its trade relationships and negotiating a bunch of new free trade agreements. So um, you know, this is partly about having more markets for European exports, but it's also about securing access to critical raw materials and key inputs. So where Europe is on track to formally and completely approve the free trade deal with the US that was agreed to by Presidents Trump and von der Leyen. I think it's going to be approved in a couple of weeks. I think mid-June is when everything's going to be signed, sealed, and delivered. Um, but the EU has also concluded trade deals with India, with Mercosur, with Mexico. I think agreements are close to being finalized with Australia and Chile and Indonesia and South Korea. And I'm forgetting a few countries, but there's been a lot of effort to boost these trade ties and to formalize them in treaties. And one big difference when the EU does this compared to, say, the United States is that they get the lawyers involved, they get the technocrats. These are actual agreements that are binding and legally enforceable. And so for a business, you have certainty that you know what you're getting into, you know what the tariffs and health and safety regulations are going to be. And diversifying Europe's trade, but also being an anchor for maintaining a global rules-based international trading system, I think is important.
Yeah, and collaboration and closer collaboration is also a way to increase innovation within with the trading partners. Savings and Investment Union and specifically EU Inc. I would like to talk about that a little bit because this is really a long-term theme that, I mean, long-term in both directions. We've been talking about it for a long term, and it's going to last and make a change for the long term. The efforts to mobilize more capital inside of the EU. We used to call it the Capital Markets Union. Now we're calling it the Savings and Investment Union. We want to invest the money that is now held in savings accounts, invested back into the capital markets. For folks less familiar with the discussion, what problem is the Savings and Investment Union trying to solve within the EU?
Yeah, okay, thanks for that. And indeed, you're right. I mean, our famed institutional investors slash pension funds sit on less money, as of less assets under management than the whole of the household deposits in bank, which are now low yielding, which are about 10 trillion. So that's a huge amount. Yeah, so that could deliver a huge boost, and that is what the Savings and Investments Union, which is kind of a top up, no, even bigger than the Capital Markets Union is going is aiming to deliver. So bring these funds to productive investments. Now the question is, do we do that with disregard of the EU, and do we kind of go full capital markets? The idea is not like that. I mean, there is a benefit to the bank-based system that we have in the EU. The problem is not that there's too little bank lending or bank available. The problem is rather in the EU that there's too little equity. So the idea would be to have this deposit to bring up the level of equity, so that you can have a kind of flywheel effect in which both reinforce each other. So you can have more bank lending and more equity and more productivity and higher growth. So that is kind of the bird's eye view of what the Savings and Investment Union is targeting, like this 10 trillion, bring it to the best use, make best use to the EU economy. And indeed, I mean, the whole Capital Markets Unit is about developing a capital integrated capital market. And we had in December last year, we had the market integration package coming out, which was a huge step and gave new impetus and to this capital market integration. But so there we are.
Yeah, and it's kind of like a doubling up, no? I mean, we want to move more money into the capital markets of the member states, but then also connect the member states to get an exponential growth of the effectiveness of having more capital floating around. And then, I mean, money generates money.
Yeah, exactly. That's why I'm saying equity and lending, so they reinforce each other. So you can bring up the level. It's just a pity
just to underline those points. I think it's about giving firms better access to capital, and it's about giving households access to better returns. So if you can unleash this 10 trillion sitting in bank accounts, not only does it mean that you're going to have more capital for, especially for startups and tech companies to invest, We know that there's massive investment needs across Europe in energy and defense and advanced manufacturing and high tech. Um, so there's demand for this capital, but households will also benefit by getting a much higher return on their savings. You don't earn much when your money's sitting in a bank account. And
It makes me cry. It's
yeah,
bad.
and so, what the commission is doing is trying to address this issue of fragmentation because essentially there's, you know, capital markets and banking markets in each European member state. There's too many central clearing counterparties, too many securities depositories, too many trading venues. You want to, have some scale. And so there's like a three-pronged strategy of trying to harmonize rules at the EU level, making it easier for financial institutions to operate across borders. There's going to be licenses for pan-European market operators and easing and harmonizing rules so that pension and insurance companies, pension funds can operate in multiple different countries as well. And you're also going to transfer some of the supervision to ESMA, the European Securities Market Authority, I believe is what that acronym is for.
We just had Verona Ross for a presentation. Fantastic discussion.
Okay, so I mean, you know, so I'm sure that he went into much greater detail than we can do there, but and there's also a focus on digital. There's going to be, easing the rules for blockchain and digital central bank currencies. There's the 28th regime that's going to make it easier to set up a company, EU Inc., as Willem was telling me about the other day. And there've also, I also want to highlight that there have been major reforms in a few countries, and particularly the Netherlands, which has moved to 401k style defined contribution pension system. And so that just creates this sort of permanent flow of money going into managed funds that can then be invested in equity markets, in bond markets, potentially even, private equity, private credit, we'll see. So all of these are a significant effort to move in this direction. And my understanding is that there's going to be a big package of all these proposed reforms published at the end of this year. And there's a lot of anticipation, both inside and outside the commission, of to see what the full package entails.
Yeah, so I mean, I can't wait for it. Why should American investors pay attention to these reforms? What opportunities can, especially the Savings and Investment Union, create for U.S. companies? And for U.S. companies and more broadly for U.S. investors?
Well, the reason is to make money. There's big opportunities to make profitable investments in Europe. This isn't about, solidarity or anything like that. This is about profit. And I think that you know there's a lot of areas where Europe is strong. One thing I think that's worth mentioning, the most famous tech company in Europe right now is this Dutch firm ASML. That's basically the leading, it's almost a monopoly supplier of lithography systems that are used in semiconductor production. They are the leading edge of this technology, and they are like the most famous AI enabler, right? So if you're building out data centers and you need lots of new equipment to go into this data center to run your AI agent or whatever, um, yes, there are these fabs in Taiwan and South Korea that make many of the semiconductors, but they couldn't make any of these chips without ASML's lithography systems. They are crucial. And there's other European companies as well that are, involved in enabling the build out of the whole AI ecosystem and all the data centers and everything. So there's opportunities there, but also just in terms of the things that we've been talking about already of energy independence. There's a lot of EU firms leading on electrification and building out grids and creating new renewable capacity.
Batteries.
Pharmaceuticals is another big sector. So there's really lots of areas, and And then, of course, there's defense because there's huge developments going on in drone technology, just to pick one example. And so I do think that there's lots of opportunities in Europe, and the reason to invest is to make money.
Yeah, let me
And
add,
advanced
yeah, totally
manufacturing,
agree.
I think, is a major sector as well.
Yeah, sorry?
I said advanced manufacturing is a major
Ah,
sector as well.
yes, absolutely. No, I mean, and of course the talk of the town here, but where there are also huge opportunities for the US investors will be AI. Even if, so to say, the EU might not be yet at the level of US or maybe China, that gives opportunities to choose for the EU, and it gives you, the EU has shown in the past, the stable labor relationships help with adopting and implementing and finding implementation opportunities. So the productivity growth that is expected here to be maybe up to 0.8% of the GDP point increase in the productivity growth. Why that should also come to
Good point.
Europe in part, and that means simply that you have more growth, more opportunities, and that can be brought to Europe also by US investors. Now, I mentioned three dots. I gave away two, but Ben also referred to the EU Inc. The 28th regime. It's part of the 28th regime. So you will have an EU EU company statute is now proposed, and that will help. That's also will also be open for American investors. So if you think of coming to Europe, starting a business in Europe, that will allow you to have to choose the country where the member state where you will have your statutory headquarters, but you can then you're supposed to apply or comply immediately with the EU regulations, and so you can do businesses throughout Europe. The third dot I wanted to mention, that I wanted to connect, is the Scale Up Europe Fund, which may in due time open up to US investors as well. For now, it's 1 billion from the European Commission, 4 billion from private investors in Europe. It had been announced only in October last year, and it will be starting already this year in the fall of this year. So, and this is the part. So we have quite a good startup environment, is the analysis, but the scale up leading up to IPOs. And here comes again the Savings and Investment Union and the Capital Markets Union. There is still a lack of funding. So this is what the Scale Up Europe Fund is doing, is going to do. And it's this gap that within a year has become operational. I mean, that is just, for bureaucrats, that's lightning speed from ID to implementation, and having a major European private equity partner lead this with huge experience and 230 billion already in portfolio. That suggests a lot, and including actually the Dutch pension fund that Ben mentioned. They're also participating. Now the idea is to have this first, get this going, and then open it up again. So there are huge opportunities.
Yeah, and the scale up is where the rubber hits the road, because it's easy to raise money in the beginning, and it's fairly easy to do an IPO. But the middle section is where it's hard to raise money. I hear it so often. People, I talk to investors about certain companies, and they're telling me they're not asking for enough money, because you're out of that bracket. You're in the scale up. You're not.
Yeah. No, that's known. Yeah, indeed. So maybe 5 billion is too little. Maybe they'll open it up very soon.
Yeah, exactly. I mean, 10 million, don't talk to me. I'm just looking in the few minutes that we have left, what I still wanted to cover. We talked about opportunities for collaboration. One thing where I mean, I obviously have my own opinion about that. I think it's much more bullish than we think. the geopolitical environment has become a little bit complicated in recent years, but has that actually strengthened the strategic logic of EU-US economic cooperation in your view? In my view, it has. I can answer the question because I see a lot of collaboration on the business to business level. It's, I mean, more than ever actually. But what are you hearing from on your end?
Yeah, I agree. I mean, just to take a narrow definition of geopolitics, I think there's two big areas where there's going to be, continued close cooperation, and in some cases it might deepen. In terms of the economics, the issue of Chinese current account and trade surpluses, is an issue. There's been all this trade diversion away from the United States of Chinese exports. And this is an area where I think that you could see even closer cooperation between Europe and the United States. There's needs to be some efforts to reduce the subsidies that Chinese provide to their manufacturing companies. Europe, and it's not just that there's trade diversion so that Europe is importing more stuff from China. They're also selling less stuff to China. So I think that there's a lot of areas for cooperation there. And secondly, on defense, because the world continues to be a dangerous place. And the fact of the matter is, I think if you cut through some of the rhetoric, basically the United States is asking for help in providing, global security, and Europe is fully capable of doing that. There's a big ramp up in defense spending across the NATO countries. Actually, let me give you a number here. Defense spending in Europe rose 0.4% last year. It's going to be another 0.6% of GDP increase this year. NATO countries in Europe are already spending 2.3% of GDP on defense. That's going to be 3.5 by 2035. So there's going to be a lot there. We still have these conflicts going on in Ukraine and the Persian Gulf, and there needs to be resolutions that for better or worse, involve some military capabilities and showing strength. So those are two areas where I think the outlook is good.
Okay, thank you for that. Risk outlook and final takeaways. What do you think are the biggest downside risks you're seeing right now, and what are you seeing on the upside, especially when it comes to some of the reforms that have the biggest impact on if executed well?
Wow, look, the risk is clearly how long the conflict in the Middle East goes on, and how long the Strait of Hormuz remains closed. But this is both an upside and a downside risk, right? If it stays closed for a long time, you're going to see higher inflation, you're going to see slower growth. But if there's a resolution, you could see energy prices come down, probably not all the way to where they were in February, but come down quite a bit. I think trade policy is already starting to calm down a little bit. Hopefully that'll continue. AI is a big question mark, but I think in the short term, it's looking like it's modestly inflationary because there's so much investment in new data centers and new capacity. But in the long run, nobody knows what the impact on labor markets is going to be, how much it's going to boost productivity, what it means for skilled workers in particular. But yeah, maybe I'll stop there.
Okay. Willem, do you want to add to that?
No, I think there's an overview over here what the spring forecast has identified as a risk. As I said, this is the take from Europe. We could also take the take from the US, and then some of the pluses and minuses actually would balance a bit different. For instance, on AI adoption, actually that could lead to a huge potential. There's a huge potential in the EU, I would say. It mentioned structural reforms, but it didn't yet mention the structural issues that we discussed, like the Savings and Investment Union. like EU Inc., like the grid package, which we already introduced, so have one energy market. I don't know, like the MFF. We didn't talk about the MFF, but maybe that's for a later time. But if you talk about an increase in defense spending in the MFF, it will be 5 times the next MFF. So from 2028. So they're huge. It's big, and the risks are to the downside, of course, clearly. But we've also tried to make the case here that this is not 2022. So we shift off some from the GDP growth for 26, a little bit from 27, and an increase in inflation. But overall, the institutions are robust. Inflation expectations will come down, are well anchored. They will not come down. They are well anchored, the inflation expectations, maybe even better than in some other places. So over the financing conditions we discussed. There are downside risks and there are upside risks. I think the downside risk will in part covered by our structural reforms. And the more pressure there's always more EU.
Well said. Well said. We actually have a question from the audience that is along those lines. Are fears growing that the U.S. markets have reached a Senate? And what's your view on the dollar versus euro exchange rate going forward?
Well, the value of the euro is in the marketplace. I think many ECB presidents have reiterated that. I mean, it all comes down to the financing conditions and the relative attractiveness. And over time, you've seen the shifts and the willingness to take a risk in the US market versus the willingness to take a risk in the EU market, hedging against those risks which have driven EU or the euro-dollar exchange rates. I was surprised when it comes to this overvaluation or high valuation of the stock markets. If we showed a graph on EU stock markets, and I was surprised when reading the spring forecast from the colleagues that we don't have an AI sector in there.
Interesting. I mean, I really don't think it's not a fair comparison because the euro is not a reserve currency. So there's so many factors that make the US dollar very special. So it's not really a one-on-one comparison. But what worries me is the bond market. I mean, I'm by no means an expert, but the cost of borrowing going high like that's something that worries me, especially for the US. If I may give one of the answers.
There's a question as to, I mean, increasingly you've seen some of the AI capex be funded through debt. So there is a question of how interest rate sensitive some of the AI investment is. But it's clear also that demand is just going through the roof. And adoption of AI is going to happen very, very rapidly. And the capabilities of the models are improving, almost every day. It's incredible the amount of progress. So I think that while we have no idea which companies are ultimately going to benefit the most, I think it's clear that AI is real and it's coming, and we need to start thinking about more seriously about what it means and how it's going to transform business processes and things like that. But just on borrowing costs, I would note that I said this before, but I think this is a good place to close. The sovereign spreads have not widened in Europe. There's been an increase in bond yields because inflation has gone up, but you're not seeing any kind of contagion that you saw back in the old days when we were talking about sovereign debt crises and things like that. Those days are well in the past, in the rearview mirror.
Yeah, for sure. Without a question. Closing question, and answer it in 2 or 3 words. What gives you the most confidence about Europe's economic future over the next 2 to 3 years?
It's highly educated workforce.
Okay. Willem?
It's aptitude at adapting to the circumstances and the possibility of AI, and I think that's widely underestimated. 80% of those aged between 15 and 29 actually already use AI privately. Just imagine what that. Yeah,
Every
well,
day.
I thought it was 100%. Looking at my kids, I thought it was 100%. But
Yeah. No, you use it all the
but they
time,
are
and it's
there. They are much more advanced than we are, and so that's going to be a good future when they
yeah, we're
when
using
they
it
do that.
every day. I mean, here at EACC, there's not a day where I'm not chatting with Chatty, as I call him. Thank you so much for the discussion, Willem and Ben. Good to see you as always. It's
Thanks
really,
very much. It was a pleasure to be here.
it was really good, really good.
Yes, I enjoyed. I
Yeah.
enjoyed it as well. Thanks a lot for having me.
And it's like I can recommend for everyone to actually read the forecast. We're going to put that up on the website. It's really interesting, and we're adding the summary and then a link to the entire report. And to wrap this up, Europe is not claiming to be immune from shocks, but like Willem said, we're highly adaptable. So. I mean, it's obvious that I would say that, but the future of Europe is bright, and the future of transatlantic relations. I mean, you heard it here first. They're still going strong. And I'm really super bullish on the Savings and Investment Union. I mean, I'm seeing what the stock market is doing here for investors. And I totally appreciate that only 30% or so of Americans are actually benefiting from that, because only 30% are invested in the markets. But for Europe, it's a new beginning. I'm telling you, I am so bullish on this. It's not even true. But I would like to thank you again, our audience, and we will put up a recording on our YouTube channel as always. And I have to say it, if you're not a member and you want to hear more of these kind of discussions, join us. The only way we exist is membership. And thank you, everyone. Have a wonderful rest of the day. And check our website for the entire report. Good stuff.
Thank you. Yes,
Thank you,
thank you.
everybody.